Hello, everyone. Welcome to Board of Studies live learning classes. I am CA Kriti Chawla. Just as an introduction, I'm a chartered accountant, a company secretary, and I've also done LLM International Tax Law from King's College London. It's been about 10 years that I have been practicing transfer pricing, and that's the topic that we have for today. So it's been about, I started practicing way back in the year 2015 after I completed LLM in international tax law. And thereafter, it's been a long journey that I've only been practicing transfer pricing. I've written books on transfer pricing, and I'm very excited and passionate about this particular subject. And so, hence, the topic that we have for today happens to be transfer pricing. As far as the today's lecture is concerned, we will be focusing on the introductory aspects to transfer pricing. But before that, we have a few rules to this particular classes. If you have any questions, you can obviously post them there. What I'll do is, as we take on a particular topic, I'm going to take those particular questions then and there. So you don't have to wait towards the end of the lecture to actually ask your questions. As we are taking a particular topic, I'd like you to address your questions then and there. I don't want you to wait towards the end so that, you forget the questions and don't ask them. So as we take a particular topic, just address those questions then and there. I will give you some time that you can, we can focus on those particular questions and answers. We can have a discussion around it. And then only I'm going to move to the next topic in transfer pricing. I'm going to, at the same time, just keep flipping my screen to see any questions that you have posted out here. So that's going to go side by side. As far as this particular lecture is concerned, our topic, as you all know, is going to be transfer pricing. If you look at, the course manual, if you look at the study manual from the institute, it's a very lengthy chapter. So what I've done is I've divided the entire chapter on transfer pricing into 3 parts. The first part is going to be around introduction and a few concepts that you should know in transfer pricing. And that is what we're going to focus on today's lecture. So the first lecture is going to be introductory aspects and then some key concepts. The important point is that this particular lecture is very, very important because this particular lecture is sort of, will become the base to understand the concepts going forward. So just be very attentive in today's lecture because I'm going to introduce very basic terms and these terms will be needed in the 2 lectures going forward. So the next lecture is going to be on Friday, this Friday, and that particular lecture, we will be focusing only on transfer pricing methods. And then the next lecture after that, which is going to be on Monday, we will be focusing on dispute resolution, penalties, etc., as it relates to transfer pricing. So 3, lectures going forward, and all the 3 lectures will be focused on transfer pricing, but I'm going to take it slow for you guys. Another thing is that I will be obviously sharing the presentation with you guys. This presentation, I hope, will be very, very useful to you. You'll know as we progress in this particular presentation. And the thing is that I will be sharing the PPT version of this particular presentation. I'm not going to share the PDF version. And that is because there are these notes that you see right here. These notes are there on most of the slides, and these notes will actually help you when you revise through this particular chapter. So these notes here will be, helpful to you. It will just help you recapitulate on what we discussed in the lecture as when you, progress to revise through this particular topic on transfer pricing. So let's get started. Okay. So as far as this particular lecture on transfer pricing is concerned, I'm going to start with what exactly is transfer pricing. But before that, I'm going to address what exactly was the need to have transfer pricing. So, we'll discuss these 2 case studies. And through these particular case studies, you'll know that, what was really missing that the government of India or, the regulations around the world, they introduced something called transfer pricing. What was the problem that they introduced transfer pricing? This is not there in the study manual, so just be very attentive to, this particular concept, and this will form the basis to why transfer pricing actually came into place. Then we'll discuss, the concepts in transfer pricing, and I'm going to address some key terms in transfer pricing. So, there are something called comparable transactions, uncontrolled transactions, controlled transactions, etc. Or, something like arm's length price, etc. We'll discuss what exactly is the meaning, and then going forward in the next two lectures, I will be using these particular terms and terminology, very swiftly. Even in the chapters, you would see that these terminologies are used. So I've, dealt with these particular terminologies in the first part of today's lecture. Then we'll go into understanding what exactly is something called the arm's length principle. I'm sure you've heard about this particular concept because this forms the basis of transfer pricing. If you see any transfer pricing regulations around the world, they all follow something called the arm's length principle. So what exactly is this arm's length principle? This is what we'll discuss. And then finally, we'll go into transfer pricing regulations in India. So we'll discuss Section 92 to Section 92F of the Income Tax Act 1961, because these particular sections deal with the transfer pricing code in India. And within that particular, sections, there is something called associated enterprises or related parties that we'll discuss. So, there are these lot of instances where two parties can become related to each other. We'll discuss, when can they be related to each other. It's provided in Section 92A, and we'll discuss that very, very, in a very detailed manner. Then we'll discuss Section 92B, which is what is international transaction. And then there's another concept which is called deemed international transaction that we will be discussing. So that's all that we have for today. Just something which is very basic and very introductory is what we have for today. I will discuss, what I've done is I will discuss whatever is the marks and what is the marks allocation for, this particular concept in transfer pricing. What are the kind of questions? But I thought that I'll address it towards the end because you will know by then what are the concepts. If I discuss right now that these are the kind of questions that will be asked, etc., you will not have any much idea because you do not know about the concepts right now. So I thought that I'll discuss about the questions, the kind of questions that will be asked towards the end, because by then you will be very accustomed to what she's talking about. So if I say that transfer pricing methods are important, you will know by then that what exactly are transfer pricing methods. So let's discuss the question paper and the format and the marking scheme, etc., towards the end, which will be the third lecture. And I'm going to devote half an hour in that particular lecture to discussing this particular concept. Okay, is that clear? So I will be discussing the topics as well. What is important from an examination point of view? Everything is important, but still we'll discuss what are the kinds of questions, etc. We'll discuss that towards the end. So we'll go on to transfer pricing right now. And in transfer pricing, we will be discussing the first thing, which is what was the need to have transfer pricing? Can anyone tell me what do you think is the need for transfer pricing? Why did they introduce transfer pricing in the first place? Why do we have those regulations in India or even worldwide? Can anyone put it in the chat box very quickly? Okay, what was the need to have transfer pricing? That's the question. Exactly, to avoid tax evasion. Well, yes. Well, I'd say to avoid something called tax avoidance, so as to make sure that there is no tax avoidance which is happening. Is that the reason that they actually introduced something called, transfer pricing in India? Well, there is something called a difference between tax avoidance and there is a difference between tax evasion. The primary difference between tax avoidance and tax evasion is that tax evasion is something which is illegal, whereas tax avoidance is again minimizing the tax liability, but by using means which are still sort of legit that ways. So yes, this is the reason that we actually have tax evasion and tax avoidance. Tax avoidance is more like minimizing the tax liability in a very legit manner. However, tax evasion is minimizing the tax liability, but it is actually using unfair means so as to have minimizing the tax liability. But as far as transfer pricing is concerned, I'll tell you going forward also that this is to minimize the tax liability by using tax avoidance methods. And we'll talk about what exactly is this. But coming back to this particular concept, which is what was the need to have transfer pricing? Well, the need to have transfer pricing is provided in this particular slide. It says, yes, exactly. To avoid tax evasion, to capture related party transaction, to bring traceability of international transactions, tax avoidance, to protect tax evasion. These are the reasons that we actually have something called, transfer pricing, into place. So I'll give you a background. What happened was there is a significant amount of transactions that happen between related parties. If you actually talk about, transactions between, related parties, about 30% of the transactions happen between related parties. So if you talk about, all the world transactions, about 30% of the transactions happen between, related parties. Well, when I say between related parties, it basically means that, transactions between a parent company or a subsidiary, or a transaction between two subsidiaries of the same multinational group, that is called intra-group transaction. So, as an example, let's say that there is a company which is headquartered in, say, for example, India, and then it's got branches in, it's got, subsidiaries in UK, USA, Germany, China. So that particular transaction between the Indian entity and the UK entity, or transaction between the UK entity and the US entity, or between two different subsidiaries, these are intra-group transactions. So transaction within that particular multinational group. So what I'm trying to say is that if you look at world trade, all the transactions throughout the world, about 30% of the transactions happen between related parties. But the point is, what is the problem with these particular transactions? I mean, why are we making a big deal out of these particular transactions? Well, the problem is that if you look at any random party transaction, any unrelated party transaction, well, they are driven by market forces. Well, when I say they are driven by market forces, they are driven by the mechanics of demand and supply, and they happen at open market price. So, if you look at any particular random transaction in the market, so, between two different entities that are not related to each other, which are, any random enterprise in the market. So parties which are not connected or not related to each other, if you look at the transaction price, if you look at the price at which that particular transaction has happened, that is the open market price. How does the open market price operate? Well, the seller would always want to sell at the maximum price possible, and the buyer would always want to, buy at the lowest amount possible. And hence they, the buyer and the seller would negotiate, and they would come to something called an open market price. So, there's always demand and supply which is involved. There are market forces that are involved when two unrelated parties are transacting. But the problem is that when related parties transact, they do not transact at this open market price. They do not transact at, in open market conditions solely. They transact at the price which is influenced by the relationship that exists between them. When I say that, they are influenced by the relationship that exists between them, they are not entirely driven by market forces. They are driven by that common interest of these particular entities in that particular group. So what happens if they are influenced by these relationship that exists between them? Well, the problem is that they are able to manipulate the transfer price, and they're able to manipulate the tax liability that they have to pay in a particular country. And that is not really reflective of market conditions, and that is not really reflective of economic reality. So what I'm trying to show is that, when unrelated parties transact, or when independent parties or, some random parties in the market transact, they transact at open market price. But when related parties transact, they do not generally transact at open market price. They transact at a price which is at their whims and fancies, at the price that they want to transact at. And why do they do that? Well, so as to minimize their tax liability, or so as to pay less tax in a particular nation. And this is the problem that we'll discuss using this particular case study going forward. Well, just allow me a minute. I'm going to zoom in the PPT a little more. Okay, is this better? Okay, please, if you can drop a yes, if this is better. If this is better view of the PPT now. Okay, great. So now the problem is that, when related parties transact, they are not transacting at, the open market price, or they're not transacting at mechanics which is operating out of demand and supply in the market. This is the problem that I'm going to define using this particular case study. Well, let's look at situation 1 in this particular case study. In situation 1, we're talking about, any two random independent parties in the market transacting. And I'm going to talk about what is uncontrolled transaction in, some time. But let's just see situation 1, which is independent parties. Now, there is, let's say, a company in India. And this particular company in India is selling to an overseas company as in any particular company which is outside India. So this particular company in India is selling to some independent company outside India some particular goods. So the cost of these particular goods is 60 rupees. The selling price of the Indian entity is 120 rupees, and hence they make a profit of 60 rupees. 60 rupees is the profit which is being made by the Indian entity. The tax in India is, let's suppose, 30%. So this particular entity will be paying a tax of 18 rupees. So the overall tax burden of the group is 18 rupees. Now, what we'll do is we'll look at the same situation, but let's say the situation now happens between related parties. So there is situation 2, which is the same transaction happened between related parties. And I'm going to talk about what is controlled transaction in a while, but let's say situation 2 is related parties. Now, in this particular situation, the parent company is in India and it has an overseas subsidiary. So now instead of some random enterprise, the parent company is transacting with its own subsidiary, which is outside India. The cost of that particular good, the good is the same, everything is the same, just that they are related to each other now in situation 2. The cost of the good is 60 rupees. And the selling price now is not 120, it is 80 rupees. Well, 80 rupees is, what the parent company and the subsidiary have decided on. They said that we know that the open market price is 120 rupees, but because, you're related to me, the parent company and the subsidiary, they are related to each other. They decided that let's transact at something called 80 rupees. We're not transacting at 120 rupees. So they decided that they're not going to follow demand and supply economic conditions. We'll transact at 80 rupees. The cost of the good remains 60 rupees and the profit comes to 20 rupees. The tax is again 30%. So the tax now becomes 6 rupees. So in this particular situation, the tax is 6 rupees. So if you look at this particular situation, they were able to bring the tax burden down by 12 rupees. It was 18 rupees initially, but now it is 6 rupees. And why did that happen? Well, that is because related party transaction happened, and these particular related parties transacted at a price which was determinative of the relationship that exists between them. It wasn't determinative of market forces. It wasn't happening at open market price. It happened at a price which was driven by their relationship and not reflective of economic reality. And hence they were able to bring the profit down. Now, this is the problem that they wanted to address through something called transfer pricing. This is where, the MNCs, they sort of fix up their prices. They fix up their price to 80 rupees. And what is, the result if effect of it? Well, the effect is that either there is, very less profit, which in this case was 20 rupees instead of 60, or the profit is absolutely no. And by this particular reason, they are able to bring the tax burden also down. So this is the problem that happens in related party transaction, that they do not transact at a market price, an open market price. They transact at a very different price, and this is the problem that they are trying to fix. Now, what I'm going to do is, while this is, just one leg of the transaction, there is also another leg of the transaction, which says what happened to the overseas subsidiary? What is the amount of tax that they are actually, paying there? That is what in the next example, we're going to see both sides of the situation. But is this particular problem clear? Well, just to, answer your question, transfer pricing happens in international transactions mostly, but in some countries it happens domestically also. India is one of the country where we have domestic transfer pricing provisions also, and I'm going to discuss that in the last lecture, where we discuss something called specified domestic transactions. But generally, international transfer pricing happens on international transactions, but very few countries where it happens domestically also. India is one of them. I'm going to discuss that very, very soon. Okay, great. So this is where transfer pricing problem really arises. This is exactly a classic example of something called tax avoidance, because they were able to avoid the tax by 12 rupees by actually moving the sales figure a bit. They were not transacting at an open market price. Let's look at another problem where, the same situation happened. In this particular problem, I'm going to discuss this problem in detail, but in this particular problem, what happened was that there was shifting of profits from a high tax jurisdiction to a low tax jurisdiction. So shifting of profits from a high tax country to a low tax country. And through this particular problem, I'm going to address how tax avoidance strategies really happened and where is transfer pricing coming into play. So let's take, this particular case study. In this particular case study, let's look at the blue font first. Sorry, the black font first. Don't look at the red one first. First, we'll discuss situation one, which is the black font. Don't focus on the red font. So this is a situation where there is a company which is called F company. And what it does is it sells to some independent party, which is company I. Company F and company I in situation one are not related to each other. They're independent enterprises. So what happens is company F sells to company I, and then company I sells to third party customers. This is what is happening. So company F is incorporated in India. The tax rate in India is 30%. And then company I is incorporated in Singapore. The tax rate in Singapore is 17%. Now, what happens is that company F sells goods to company I. The selling price of the good is $1,400, and the cost of the goods to F company is $1,200. Hence, they make a profit in India of $200 because sale price is 1,400, cost of the goods is 1,200. So the profit is 14 minus 12 is $200, and this is the profit that they make in India. Now let's look at this particular situation. The profit is, if you see, 200. The tax rate in India is 30%. So that means the the tax that they pay on profits in India is going to be 200 into 30%, which comes to 60. So that is the situation in India. Now, company I, because company F is selling to company I purchases these particular goods and they purchase it at $1,400. So sale of goods by F company becomes purchase of goods by I company, and it's $1,400. The cost of these particular goods to the Singapore company, which is I company, is $100, and they sell it to third party customers at $1,600. So the profit that they make is $100, and this particular $100 of profit that they make is in Singapore. The tax rate in Singapore is 17%. So profit in Singapore is 100. Tax rate in Singapore is 17%. So the tax is 17. So if you look at the entire group tax, the entire tax that they have paid as a group, it's going to be 60 in India, and 17 in Singapore. So the entire group tax is going to be 77. Is this much clear? Okay. So this much is clear. This is situation one. There is a question out here which says whether one person should be compulsory non-resident, etc. I'm going to address that when we discuss the concept around international transaction. It should be addressed. I'm going to address this in slide number 46 out here, whether one person should be non-resident or both resident or whatever is the situation. I'm going to address that in slide 46. It's just too premature a question right now. So this is situation one, which is that the group tax is going to be 77 out here. Now let's look at this particular situation from another angle. Now let's see that company F and company I are related to each other. So now the transaction is that company F, which is the parent company, is actually selling the goods to company I, which is its own 100% subsidiary. And then company I sells it to third-party customers in Singapore. Now this is where we focus on the red font and we look at the red font out here, which is, let's say that now because they are related to each other, company F and company I, they decided that we're not going to transact at $1,400. Let's transact at some other price which is determinative of our relationship. Because we are a parent company and a subsidiary company, we're going to decide what is the price at which we will be transacting. So then they decide that we're not going to transact at $1,400. We will be transacting instead at $1,300. So company F decides that I will sell you goods for $1,300. The cost remains the same, which is $1,200. And the profit now becomes $1,300 minus $1,200, which is $100 in India. So now the profit is $100 in India. The tax rate remains the same, which is 30%. So the tax is $30 in India. Now what happens is they sell it to Singapore entity. The purchase price for the Singapore entity becomes $1,300. The sale of goods is at $1,600. And the cost remains the same for company I, which is the Singapore company, which is $100. So now the profit becomes 1,600 less 1,300 less 100, and now the profit becomes $200 in Singapore. The profit in Singapore is $200. The tax rate remains the same, which is 17%, which becomes $34. And now if you see, the group tax is 64. So 30 in India and 34 in Singapore, it becomes 64. So what happened was, if you look at, the situation, just because, they were able to influence this particular price, which is $1,400 initially, and now they're transacting at $100 less, which is $1,300, they were able to bring the group tax down to 64 rupees. So there is a group tax saving of 13 rupees. And this particular tax saving happened only because they did not transact at an open market price. They transacted at a price which was a situation which was, driven by group market forces and not generally the market forces of economics, demand and supply. They transacted at their own price, which is also called incorrect pricing, or they transacted at a price which was unjustified. They transacted at mispricing, etc. And this is where issue of tax avoidance and tax evasion arose, because they saved on taxes by transacting at their own price. They did not pay their fair share of taxes. And this is a classic example of shifting of profits from a high tax jurisdiction to a low tax jurisdiction. So initially the profit was 200, high tax jurisdiction is India, but they moved 200 from 200, the profit was, 100 in India. So they moved $100 to Singapore, which is a low tax jurisdiction. So they moved $100 from a high tax jurisdiction like India to a low tax jurisdiction like Singapore. And they were able to do that only because they transacted at something called their own price, and they did not transact at the open market price. And this exactly is the problem of tax avoidance and tax evasion that transfer pricing decides to fix. Is this much clear? Is this particular problem clear? Okay, you can take some time, look at this again. But if you have any questions, please let me know. Okay, great. So this is the problem that they were trying to fix using something called transfer pricing. And for this particular purpose, here comes transfer pricing rules. So what exactly is transfer pricing? Well, it's all provided here. If you look at transfer pricing, it is at the outset, I'd like to tell you that it is not really a tax. So, it's not like a tax like, TDS. It is not like a tax, like equalization levy kind of a thing where there is, 1% or 2%. It is not like a TDS, which is 1%, 10%, etc. Transfer pricing is more like an anti-tax avoidance law. This is more like a law which has been devised or a regulation which has been devised so as to make sure that there is no anti-tax avoidance strategies that are prevalent. So there is no tax avoidance. This is the reason they've come up with transfer pricing. So it is an anti-avoidance law so as to make sure that these kind of situations do not arise and everyone pays their fair share of taxes. This is the reason they came up with transfer pricing law. So if you look at transfer pricing, it is just a law in place so as to make sure that related parties should also transact at a price at which independent parties are transacting. They should not transact at a price at which, which is at their own whims and fancies. They should transact at a price at which every other independent party is also transacting at. So this is the law which is, in place to make sure that related party transactions also happen at a price at which independent parties are transacting at. This is hence transfer pricing, they say, is the general term for pricing of cross-border intra-firm transactions between related parties. So you have to make sure that it is a cross-border transaction. When I say cross-border transaction, it basically means a transaction between India and an overseas subsidiary. Cross-border as in an international transaction. Then it should be intra-firm transaction. When I say intra-firm transaction, it should be a transaction which is happening within a particular multinational group, as in between related parties. It should not be a transaction between independent parties, because if it is a transaction between independent parties, they will obviously transact at open market price. But only if it is a intra-firm transaction or if it is a transaction between related parties, transfer pricing comes into play. So transfer pricing means the setting of prices at which transactions occur involving transfer of property or services between associated enterprises forming part of a multinational group. So you have to make sure that when there is an international transaction, this international transaction happens between related parties, or, we also call related parties as associated enterprises. And I'm going to talk about associated enterprises in detail. That is where transfer pricing comes into play. So what is the price at which international transaction between associated enterprises happen? Well, that is transfer pricing. What is the price? That is where transfer pricing law really comes into play. So this is the entire concept, basic concept around transfer pricing. Now, what exactly is international transaction? What exactly is associated enterprises? What is the meaning of transfer of property or services? What is the meaning of property? What is the meaning of services, etc.? Everything is defined in the Income Tax Act. We'll talk about that in detail, but this is the basic crux on transfer pricing. So before we actually go into, the details relating to transfer pricing, what I'm going to do is just describe some key terms used in transfer pricing, because, these are key terms, although they've not been, they're not expressly provided in the study manual. But then I thought that, let's discuss this in detail, because these are the terminologies that we will be using very frequently going forward. So I thought, let's discuss this first before we actually go into the technicalities relating to transfer pricing. So the first terminology is something called a controlled transaction. But before we actually go into controlled transaction, I wanted to ask, is there any question right here on transfer pricing? If there's any question, please put it in the chat box. Any question on transfer pricing right now? Any question on, whatever we've discussed till now? Okay, great. So now we'll discuss the first key term on, transfer pricing. The first one is called, what exactly is a controlled transaction? Well, a controlled transaction, in very, very simple terms, whenever there is a transaction between related parties, we call it a controlled transaction. So in this particular example, the controlled transaction is situation 2. Why do we call it controlled transaction? Because it is a transaction between a related party. Related party, as in a party between parent and subsidiary, transaction kind of a situation. We just call it a controlled transaction. The point is, why do we call it controlled transaction? Well, we call it a controlled transaction because this particular transaction is subject to the influence or control of the related parties. So, they're able to control this price. They're able to control the price at which they are transacting, 80 rupees instead of 120 rupees. Hence, we call it a controlled transaction because the transaction price, the price at which they are transacting, is controlled by the parties, or it is controlled by the relationship that exists between them. So if it is a related party transaction, we call it a controlled transaction in transfer pricing. So I've provided some examples here. The sale of goods or services between related parties. So in the first, example, if you see the transaction of sale and goods, the sale of goods transaction, it happened between related parties. This particular transaction of sale of goods, it happened between related party. We call it a controlled transaction. Similarly, it could be any transaction between related parties. So long as this is a transaction between related parties, this situation here or this one here or this particular transaction here, we'll call it a controlled transaction. This controlled transaction could be anything. Maybe there's a parent company and it is purchasing raw materials from another company, or there is a transfer of intangible. So the intangible, like and there is a definition to intangible also, but maybe there is a patent or a trademark which belongs to a parent entity, and the parent entity is selling that particular trademark to a related party. That is a controlled transaction. Or maybe a parent company is providing loan or is providing guarantee to the subsidiary company. That is a controlled transaction. Or the parent entity is providing management services, or the subsidiary company is providing IT services to the parent entity. That is all controlled transaction. The only thing is that this is a transaction between related parties. So that is basically a controlled transaction. And similarly, there is something called an uncontrolled transaction. Uncontrolled transaction basically means that if there is a transaction between two independent parties, so two parties which are not connected to each other, that particular transaction is called an uncontrolled transaction. So in situation one, this particular transaction was between two independent enterprises. And because this is between two independent enterprises, as in enterprises not connected to each other or not related to each other, this is called an uncontrolled transaction. Why is it called an uncontrolled transaction? Well, that is because you'll have to make sure that one, there is no relationship between the parties. When I say relationship, as in, they are completely unconnected to each other, they're not related to each other. And second, there is no possibility that they will be influencing or controlling the terms and conditions of this particular transaction. So they will always transact at an open market price. The buyer, as I mentioned, will always want to sell at a lower price. The seller would always want to sell at a higher price. There is absolutely no control on terms and conditions of the transaction, and they're just operating at an open market price. That is basically an uncontrolled transaction. So this is a controlled transaction between related parties, uncontrolled transaction between independent parties. The next thing is that if you want transfer pricing provisions to apply, or, the transfer pricing provisions basically apply, now we gather that there should be a transaction between related parties. That is important. It should be a transaction of transfer of property or services. And then they say that it should be a cross-border transaction. That is an international transaction. So if you read through the definition, which is provided by the UN transfer pricing guidelines, it says that there should be a transaction between, it should be a transaction between related parties, as in two entities should be related to each other. We also call them associated entities. So if you look at this particular situation, Transfer pricing will apply in situation 2, and that is because this is a situation of related parties. This is the parent company and this is their wholly owned subsidiary. So situation 1 is established that there is something called a related party transaction. Then it should be a transfer of property or services. It can be any sale transaction, any services that are being performed, etc. We'll talk about this particular definition also in detail. And the third thing is that it should be a cross-border transaction. It should be an international transaction, as in, one entity should be in India and the other entity should be an overseas entity or a non-resident company. We need one entity which is resident, one entity which is a non-resident. The moment this happens, it is an international transaction. And you know that when all these conditions will be established, transfer pricing provisions will apply. That means that transfer pricing provisions will be activated. Section 92 of the Income Tax Act will be activated, and they will make sure that these particular transaction, or in this particular situation, they will make sure that this particular transaction does not happen at any random price, but it should happen at something called an arm's length price. So this is what Section 92 says, that the moment transfer pricing provisions are applicable, the transaction price should be something called an arm's length price, and it should not happen at the price which is decided by the parent company or the subsidiary company or related parties. It should happen at something called an arm's length price. Now, the thing is, what exactly is this arm's length price? This is what is provided in, this particular slide. It says an international transaction between associated entities need to be something at an arm's length price and not any random price which is decided by these particular related parties. Now, the question is, what exactly is this arm's length price? But before I go to the next slide, which says what exactly is an arm's length price, I want to tell you that in India, transfer pricing is not just applicable on international transactions. Transfer pricing is also applicable on domestic transactions, and it is called specified domestic transactions, SDTs. We'll discuss this extensively in detail. What is the threshold? What are the conditions, etc. We'll discuss this in detail in the third lecture. But for now, we'll just focus on international transactions. So, any questions here? We will be discussing, the income tax authorities when it comes to transfer pricing. That is for the third lecture. You can, make notes, or you can actually make use of the slides. I will be, sending you this slide deck. This slide deck is, as I mentioned towards the start of the class, this slide deck is my notes. You can make use of these particular slide deck. I can assure you that the slide decks are so, extensive that you can actually just rely on these particular slide decks, and the recording of the class will be there. You can just check with everyone. So you can just rely on these particular slide decks, and the study manual that you have, and then if you like, you can make notes as while I'm talking. So if that's sufficient. I will talk about whether transfer pricing is applicable for branch or not. Give me some time. I've just introduced very, very, small concepts right now. I'm going to talk about those particular concepts also, branch, transactions, etc. I'll talk about that in today's class itself. Whether international transaction is there with a foreigner, and the buyer is such foreigner, I'm going to talk about that when we discuss international transaction. And the definition of international transaction is provided in slide 41. So I will answer your question when we go to slide 41. Otherwise, this is, it's going to become very confusing right now. So slide 41 is where I've written whether, how many people have to be non-resident, whether it is a resident, non-resident, etc. I'm going to talk about all that when we go to slide 21. I can circulate the slide deck, and then you can, take a printout of this particular slide deck, if that's, possible. Otherwise, you can make use of, the study manual. But I can tell you that the slides will be very, very helpful if you're just taking, going through the slides with me. Any other question? Okay, so the point is, what exactly is the arm's length price? The question is, we were discussing, coming back to these particular slides, we were discussing that if there is a transaction between associated entities or, related parties, and it is happening in a cross-border situation, as in they are international transaction, then it should happen at something called an arm's length price. It should not happen at any random price which has been decided by these particular related parties. So the point is, what exactly is this arm's length price? Well, very, very easy put. Arm's length price is a situation. Arm's length price is basically a price at which independent entities are transacting. So that basically means that you'll have to see what is the price at which independent enterprises are transacting in comparable situation. And that is basically the arm's length price. Some people also say that arm's length price is the open market price. Well, that is, they say it because open market price is the price at which independent enterprises are transacting. So what exactly is the arm's length price? Well, the price at which independent enterprises are also transacting, that is basically called the arm's length price. So in this particular situation, coming back to this particular situation, if transfer pricing situation is activated, if transfer pricing laws are activated, which are activated in situation 2, which is related party transaction, well, then they say that you shouldn't have transacted at 80 rupees. You should have transacted at something called the arm's length price. And what is this arm's length price? Well, they say that look at a related and unrelated party situation. Look at a situation at which independent entities are transacting, and that is the price at which you should have also transacted. So in this particular situation, which is situation 2, they say that you shouldn't have transacted at 80 rupees. You should have looked at other situations in independent situations, and they transacted at 120. So you should have also transacted at 120, and you should not have transacted at 80 rupees. So that 120 rupees is called the arm's length price. The price at which independent parties are also transacting is basically called the arm's length price. But for that, there are certain situations, certain conditions that have to be fulfilled. They say that independent parties transacting in comparable situations. So that is basically the arm's length price. That basically means that you can compare these two transactions, but for that you'll have to make sure that the good or the article that they're talking about is the same article that the independent enterprises are also trying at. So if in this situation we are talking about selling pens, so the parent company is actually selling pens to an overseas subsidiary and they're selling pen at 180, then you'll have to make sure that independent enterprise are also selling the same type of pen in a unrelated party situation. So you can adopt 120 rupees as the arm's length price, but for that, you'll have to make sure that the product that they're talking about is the same. The law goes to this particular extent. It says that if you're talking about a ball pen, then this should also talk about a ball pen. So you cannot compare an ink pen to a ball pen. It has to be very, very similar in that particular sense. So you have to look at what are independent enterprises transacting at. And in a related party situation, you have to adopt that price as the arm's length price. But for that, make sure that it is in comparable situation. When I say comparable situation, they basically mean that the product should be the same that you're trying to compare. Well, it's not just restricted to a product. They also go to the extent of saying that, the jurisdiction should also be the same. So if this is a transaction between India and UK, This should also be a transaction between India and UK. You cannot compare, a transaction between India and UK to a transaction between independent enterprises in India and USA. Why do you think they say that? That the, country should also be the same, or the intercompany transaction should happen between the same countries? So why do you think that the countries should be the same? Any reason? I'm answering these questions that are provided here. But what is the reason that the countries are required to be the same? Exactly. So tax rate is one of them. And then, there are many other factors that, the economics is also the same. So, you cannot compare the economic conditions in which the transaction between India and UK is happening. You cannot compare that economic condition to a transaction between India and USA. The economic conditions of both the countries are, very, very different. And hence, if you're comparing a transaction, you have to compare it in similar situations. In this particular situation, you cannot compare a transaction between India and, say, for example, Brazil to a transaction between India and UK that ways, because the economic conditions of both the countries are very, very different. So compare the same thing to a similar thing. So if it is a transaction between India and UK, compare it to a transaction with India and UK. They also go to the extent of saying that, if you're comparing a pre-COVID transaction, that you have to compare it to a pre-COVID transaction. You cannot compare a pre-COVID transaction to a post-COVID transaction. So, because the time frame will make a lot of difference. The economics will actually change. So when they say comparable transactions, they go to the extent that the product should be the same, the economic conditions should be the same, the market strategies should be the same. And they've given about 5 conditions out there. We will be discussing these 5 conditions in the next lecture. But what I'm really trying to say is that in this particular situation, when they say arm's length price, it basically means what independent parties are transacting at in comparable situation. Comparable situation means everything has to be the same. So that is how it basically goes. So there was a question out here. Can we transact at more than arm's length price? Well, you can transact at more than arm's length price, but you'll have to make sure as long as fair share of taxes are given, it's absolutely fine. We will be discussing where I'll tell you what happens when 2 parties transact at more than arm's length price. What is the tax situation there? And this is where we'll discuss your, example using case studies and using numbers out there. But for now, the answer is yes, you can transact at more than arm's length price. If there are no comparables, then which price we have to take? Well, if there are no comparables, then it becomes very difficult. And this is where we have 5 methods in transfer pricing. You have to make sure that you use another method in transfer pricing. I'm going to those particular methods also going forward. But if there is no, there are certain situations wherein my related party is producing or manufacturing a commodity which is not manufactured by anyone else in the entire world. What do you do then? Where is the independent party? Well, in this particular situation, we have a different transfer pricing method in place. We have 5 methods. I'm going to talk about those particular 5 methods in the next lecture. So we'll make use of those particular methods. But for now, it says that if it is a regular transaction, then it should transact at something called the arm's length price. And what is this arm's length price? It is independent. What is independent enterprises transacting at? You just have to adopt that price and transact at that particular price. But the point is, where exactly is this arm's length price coming from? Where is it provided in law? Where is it provided in? Is it provided in the Indian law? Is it provided in international? Well, yes, it is provided in international law. It is coming from something called the arm's length principle. Arm's length principle is basically a standard which is used by everyone worldwide. It is an international consensus to transfer pricing. When I say international consensus to transfer pricing, it basically means that it is being used worldwide. And this is the principle which basically makes sure that if there is a transaction between related parties, then it should happen at something called a market value. An arm's length price is actually coming from this particular arm's length principle, which basically is the standard which is used by everyone in the world. So the point is, where exactly is arm's length principle coming from? Well, arm's length principle is coming from something called Article 9 of the OECD Model Tax Convention. Where is arm's length principle provided? Well, it's provided in Article 9 of the OECD Model Tax Convention. And Article 9 of the OECD Model Taxation Convention talks about something called associated enterprises. So what exactly is associated? What exactly is provided in Article 9? Well, take 1 minute to actually read through this particular language which is provided in Article 9, and then I will explain it using the case study. Take some time, take 1 minute to read through the language which I've highlighted here. Okay. So Article 9, which is on associated enterprises, and it's provided in OECD Model Taxation Convention, it says, where conditions are made or imposed between associated enterprises in their commercial or financial relations, which differ from those which would be made between independent enterprises, then any profits which would, but for those conditions, have accrued to one of the enterprise, but by reason of those conditions have not so accrued, may be included in the profits of that enterprise and taxed accordingly. Well, you're not the only one. This was my reaction also when I read this for the first time. So yes, it is a little, difficult to exactly absorb what exactly, they are basically saying. But this is what basically means that, when independent enterprises are transacting with each other, there are something called commercial or financial relations which exist between them. So when two independent enterprises are transacting, like in this particular example, when two independent enterprises actually transacted between them, which is at 120, there were some commercial or financial relations between them. What were these commercial and financial relations? Well, they were interacting at demand and supply. There were these commercial relations between them. As I mentioned, company in India would always want to sell at the maximum price possible, and the overseas company would always want to purchase at the lowest amount possible. So there were these commercial and financial relations that they negotiated on, and they came up to a price of 120 rupees. So when independent enterprises, they transact between them, they transact using these commercial or financial relations. Then Article 9 is trying to say that, when independent enterprises transact, when related parties, they transact between themselves, they do not transact at these commercial and financial relations. These commercial and financial relations are different between related parties. Sometimes they are present, sometimes they are not even present there. So, you cannot say between related parties. So it says that these commercial and financial relations, they differ between related parties. When I say differ, well, they are, related party transactions happen at their own price, a price which is reflected of the relationship that exists between them. So Article 9 says that if this is the situation that, related party transactions are not happening within these commercial and financial relations, then because of these particular conditions, there is a difference in profit. The difference in profit is, yes, it's there. For independent parties, the profit was 60, but for related parties, the profit was 20. And why is that difference happening in terms of these particular profits? Well, that is because the commercial and financial relations were different. So Article 9 says that if this is the situation that the profit is lesser, then what tax authorities need to do is add back the profit. So in this particular situation, they say that we will add back 40 rupees out here in this particular situation, and we will tax this particular accordingly. So what they'll do is, again, they will add back 40 rupees. 40 means 60 minus 20. They say that even in related parties, the profit should have been 60. So 20 plus 40, we'll add back 40 as an adjustment, and then we will tax this particular transaction at 60 rupees, like it happened between independent parties. So what they're really trying to say is that a transaction between related parties should also happen, and in the similar manner at which transaction between independent parties happen. So that is what they're trying to say by Article 9, that because of these particular conditions, because these particular conditions were not present in related parties, what we'll do is we'll add back the profit to related party situation and then tax them accordingly. Is this much clear? I know this is very, very confusing, but if you read this particular slide in sync with this particular example on slide 6, this will become clear. How to decide the comparison? Well, the comparison will be decided by means of something called a comparability factor. It is provided in Section 92C of the Income Tax Act. We will discuss these comparisons in a lot of detail when we discuss transfer pricing methods in the next class. But today, I just want to tell you what is the arm's length price. That's it. And we're not going into comparisons, what are the factors on which comparison will be made? What happens if comparison is not able to be met? We'll discuss all that in detail in the next lecture. But today, just understand that this is what they're actually looking at. OECD Model Taxation Convention is, part of international tax. You must have read this in international tax. So OECD is an intergovernmental organization. It's called Organization for Economic Cooperation and Development. And they have come up with OECD Model Taxation Convention, which is basically guidelines, which basically say how laws are basically derived. So if there is a double taxation situation, we rely on something called OECD Model Taxation Convention. And that is, on that part, there is Article 9 out there. Article 9 in OECD Model Taxation Convention talks about associated enterprises, and the concept of arm's length principle is provided out here. And within this arm's length principle, from this, we derive something called arm's length price, and we have provided that in Section 92 of the Income Tax Act in India. So going forward, I'm going to be talking about Section 92 of the Income Tax Act. Okay, any other question? Explain 2 para. Okay, I again. Is article principle is coming from. Why do we need to establish arm's length principle? Well, why do we need to, see arm's length principle? Well, that is because arm's length principle, is a derivation of arm's length price. Arm's length price is coming from arm's length principle. This is where we need to see what exactly is this arm's length price. Where is it coming from? Well, it's coming from arm's length principle. And where is arm's length principle? It's provided in international law. It's provided in OECD Model Taxation Convention, Article 9. The reason we're discussing Article 9. Article 9 says that, Article 9 basically says that when independent parties are transacting, they transact at demand and supply price. They transact at an open market price. So if you see here, in this particular situation, when independent parties transacted, they transacted at 120 rupees. Where is this 120 rupees coming from? Well, it's coming from market demand and supply. It's an open market price. It's at which any independent enterprise would transact. So They say Article 9, independent parties transact. They transact at a price which is determined by commercial and financial relations. They are, this 120 rupees is determined by commercial relations between independent parties. But then the Article 9 says that, when related parties transact, the price at which they transact, which is 80 rupees in our example, this is not determined by market demand and supply. This is determined by, their wish and fancies, their wishes. This 80 rupees is determined by these two companies altogether, and it is not determined by commercial relations. It has nothing to do with economics. It has just anything to do with their own relation that exists between them. And that is, they decided, any random price, let's transact at 80 rupees. So Article 9 says that if this is the situation that, related parties are not transacting at prices which are influenced by commercial relations, then there will be a loss of profit. The profit will be less in this particular situation. So the profit is less here, which is 20 rupees. So Article 9 says that if this is the situation that, profits are lesser in related party situation, then what we'll do is we'll look at an independent situation. Whatever is happening or whatever is the profit in an independent situation, we'll add back that particular profit to related parties. So in this particular situation, Article 9 says that we'll also make sure that the profit between related parties is not 20, it is actually 60. So what they'll do is they'll add back the difference between, which is 40 out here, and then they'll tax it accordingly, as in they'll tax 60 rupees here also, and that will be by way of an adjustment, which is adjustment of 40 rupees. So Article 9 just makes sure that, whatever independent parties are doing, we will also do the same in related parties. That is how it should be. And that is the crux of Article 9. Exactly. That is basically the crux of this particular principle. The crux of the arm's length principle is that whatever independent parties are doing, you should also do the same, because that is open market price. So what they're really trying to say is that transact at open market price. And what is this open market price? Well, this open market price is basically the arm's length price. What is the arm's length price? Well, they say, look at what independent parties are doing in comparable situation and adopt that, replicate that. That is what is coming from arm's length principle. They basically say that see what independent parties are doing and replicate that behavior. Do whatever independent parties are doing. And if you're not doing that, then we'll make sure that we will tax you according to independent parties. That is what arm's length principle, is trying to do. Yes, there is a penalty. Also, there is a profit penalty. Also, there is a penalty which is very, very specific to transfer pricing. We'll discuss that in the last lecture itself. Okay, any questions now? This is basically the arm's length principle. Any questions now? Well, every transaction, between related parties, it is onto the assessee, it is onto the taxpayer to actually substantiate that this was at arm's length price. If there is a related party transaction, transfer pricing provisions are applicable, and then they'll have to give a certification from a chartered accountant that these particular transactions are happening at, related parties. So it is, I can't say that it is presumed, but a certification will have to be given by a CA that if it is a related party transaction, it has happened at ALP. That is our work, basically. So, can't say about the presumption, but yes, we have to give a certification and prove that this has happened at arm's length price. How is that certification given? What is the arm's length price? How do we calculate arm's length price? We'll all that in, lectures going forward. But this is, the crux right now. So, because I know that this has been very, very heavy, the concepts are very, very heavy, and this is our situation right now, I thought I'll bring in this particular slide here. Well, The concept of arm's length principle, the only reason that I actually devoted a lot of time to arm's length principle is because it is the basic principle in transfer pricing. You cannot do transfer pricing if you do not know what exactly is arm's length principle. So I thought I'll devote a lot of time to discussing what exactly is the arm's length, principle. Um, the thing is that there is, if you read through the study manual, ICAI study manual, there are also these two topics, which is significance of arm's length principle and then the practical difficulties in applying arm's length principle. If you've understood slides till 16, you will be able to grasp those two theoretical paragraphs out there, and we will discuss those two paragraphs in the next lecture. So you will have to read through those two paragraphs and come back and see if there are any doubts. But if you've understood the concept, you'll be able to understand those particular theoretical, concepts also. The next thing that we have is domestic transfer pricing provisions. Where is transfer pricing in India? But before that, I'm going to take these two questions. ALP transactions are also covered in 40A2B of the Income Tax Act. There is a section which is called 40A2B. It is a domestic transfer pricing provision. I'm going to discuss that in the third lecture when we discuss SDT provisions, which is, as I mentioned, specified domestic transactions, which is domestic transfer pricing. I'm going to discuss that in the third lecture, section 40A2B, what is the interplay. But when it comes to international transactions, the section is section 92. I'm going to explain that now. So if you talk about section 40A2B, it is a domestic transfer pricing provision transaction, but we're not talking about that right now. We're talking about international transfer pricing today, which is section 92 of the Income Tax Act. So don't get confused. When it comes to transfer pricing, just to address that question, when it comes to transfer pricing, there is always, a tax avoidance strategy in place. So as to make sure that there is no tax avoidance strategy, we have transfer pricing provisions, in India. So, whether the intention to evade tax or not, it is clear by, the transfer pricing provisions that actually happen. So let's discuss, the domestic transfer pricing framework. Where is transfer pricing in India? What is the structure of transfer pricing provisions, in India? And can you tell me when transfer pricing provisions were introduced in India? What was the year? If you can just provide the year out there. Which year was transfer pricing provisions introduced in India? You can put it in the chat box out here. Okay. When were transfer pricing provisions introduced in India? Yes, it was the year 2001 when transfer pricing provisions were introduced in India. So if you look at this particular finance minister's speech, it happened on February 28th of 2001. They said that transfer pricing was a matter of serious concern because most of the multinational groups in India most of the multinational groups across the world were actually controlling their intra-group transactions, and there was a serious concern out here. There were a lot of tax avoidance strategies that were happening. A tax avoidance strategy like this, they were multinational groups were actually shifting profits from a high tax jurisdiction to a low tax jurisdiction, and they were not paying their fair share of taxes. They should have paid a tax of 77, but they were actually, paying a tax of 64. And this was happening because of the tax avoidance strategy in place. They were transacting at a price which was determinative of their market, their relationship. And this was a serious concern in transfer pricing. And so they had set up an expert group to look into this particular, structure. And what happened after 2001 was that Finance Act of 2001, they introduced something called transfer pricing provisions in India. So if you look at Chapter 10 of the Income Tax Act, it talks about special provisions relating to avoidance of tax. Now, the point is that Chapter 10 does not say, the name of Chapter 10 is not transfer pricing. The name of chapter 10 is special provisions relating to avoidance of tax. That basically means that there were a lot of tax avoidance strategies that were being happening. And so they wanted to come up with rules so as to make sure that tax avoidance strategies are not happening. They wanted to come up with tax provisions so as to make sure that these strategies were not in place. So they came up with transfer pricing provisions. We call them transfer pricing provisions, but the name of the chapter is special provisions relating to avoidance of tax. And they were introduced with effect from 1st April 2002. If you look at the section, this Chapter 10 contains sections from 92 to 92F, and the rules are Rule 10AE to Rule 10A to Rule 10AE of the income tax rules. We will discuss all these sections one by one because they are very, very detailed. We'll be understanding them in a detailed manner. So I'm going to take all the sections one by one and all the rules also. What I've done is I've summarized the rules and the sections out here. So if you look at, the sections, section 92 talks about, that if there is any international transaction between related parties, it should happen at arm's length price. Then there is what is arm's length price. We'll discuss that. Then there is section 92A, which is what is the meaning of related parties. All this while I've been saying parent and subsidiary, but what exactly is the real meaning? What is the meaning of related parties, or what is the meaning of associated parties, or what is the meaning of associated enterprises? That's provided in section 92A. Then there's section 92B, which is what is the meaning of international transaction. Then there's section 92BA, which we'll cover in the third lecture, which is what are specified domestic transaction. Then there is the meaning of arm's length price. So I've been saying that there are methods to compute arm's length price. In our example, the price was 120. But how do you come at 120 rupees? What is the formula to compute 120? That formula is provided in section 92C, which is how to compute arm's length price. Then there is section 92D, which is documentation and the transfer pricing report, which we'll discuss. And then finally, section 92F has, some definitions which are related to, transfer pricing. So we'll take all these sections one by one going forward. Obviously, you cannot understand the sections if you do not know the rules. So the rules are accompanying the sections. 10B talks about arm's length price determination. 10C talks about most appropriate method. 10D talks about information and documentation, and 10E talks about TP form or something called Form 3CEB, etc. It talks about the report that has to be furnished. I will be taking you through these particular sections and these particular rules one by one. So don't get overwhelmed right now. We will be discussing them one by one going forward. But what we'll do is the related party transactions are transactions between related parties, obviously, and transfer pricing is not the same as related party transaction. Transfer pricing is the entire concept in whole, and transfer pricing is applicable on related party transactions. So they're not the same right now. Transfer pricing is more like a general term. It is more like the entire concept. And within transfer pricing, it is applicable on related party transactions. How will the department know this? I'm going to talk about this in dispute resolution in the third lecture. So, wait for that. Now, as far as arm's length price is concerned, it is provided in section 92 of the Income Tax Act. And if you look at section 92, it is a very small section. It just says that, listen, whenever there is a transaction between related parties, and this transaction is an international transaction, then you will have to make sure that it is happening at something called arm's length price. So meaning to say that whatever is the entire world doing, the entire world is following something called an arm's length principle. The entire world is following something called arm's length price. India is also following something called arm's length price. India also makes sure that, the moment you have a related party transaction and the moment that this is an international transaction, it should also happen at something called arm's length price. And India has done this so as to make sure that India gets its fair share of taxes. So that India has done this so that if initially in India they were paying a tax of 60 rupees, they should continue to pay tax of 60 rupees in India. They should not lower it down to 30 rupees. This is the reason India has introduced transfer pricing provisions. So as to make sure is provided here, so as to make sure that the tax base of India is protected and there is no reduction of taxable profit, or the taxes that are paid by the Indian taxpayer, they are not reduced. This is the reason that India has introduced transfer pricing provisions, and this is provided in section 92 of the Income Tax Act. Now going forward, we'll discuss what exactly is, India says that there should be an international transaction. What exactly is international transaction? Similarly, India says that, listen, whenever there is a related party transaction, what is this related party transaction? Well, this is what we'll discuss in detail, going forward. But what we'll do is we'll start with associated enterprise. If you have any questions, you can put it in the chat box. Let's take a 10-minute break here till 7:30. We'll come back at 7:30 and we will start to discuss what is the meaning of associated enterprises, which is provided in section 92A of the Income Tax Act. Let's take a 10-minute break here. If you Guys, can you confirm if the slides are visible? So slides are visible? Guys, can you please confirm if the slides are visible? Just say a yes and then I'll start. Okay, great. Okay, so now we have to start with, what exactly is the concept of associated enterprises. When it comes to transfer pricing, we have come to clarity that one, transfer pricing provisions will be applicable when one, this is a related party transaction. When I say related party, it means that there should be a transaction between, two associated enterprises. Otherwise, why would independent enterprise want to transact at, their own price? They will always transact at an open market price. It's only a situation of associated enterprises or related party transactions when they will, transact at a price so as to manipulate the tax or avoid tax, basically. So transfer pricing provisions will be applicable when it is an associated party transaction or a related party transaction. Then we've come to conclusion that, it should be an international transaction. So if these two conditions are satisfied, then this particular transaction should happen at something called arm's length price. So in this particular 1.5 hours that we have, we'll now discuss what exactly is the associated enterprise. In next section, we'll discuss what exactly are international transactions. And in the lecture day after, we'll discuss what exactly is arm's length price, or how do you compute arm's length price? Is there a formula to compute arm's length price? What are the methods to compute arm's length price, etc.? That is what we'll discuss in the next lecture. So today we'll discuss what exactly are associated enterprises. It's provided in, okay. Is this better? I've zoomed it more. I can, put a screen share mode on. I can put like a PowerPoint, presentation mode on, but then you'll not be able to see the notes, out here. And I want to take you through the notes also, because these notes will be very, very helpful when you revise these concepts going forward. So, you should know what is written out here, because then you'll be able to revise also. And this will help you tremendously during the revision period. So now the point is, what exactly are, associated enterprises? This is provided in Section 92A of the Income Tax Act 1961. So if you look at Section 92A, it is provided in two subsections. There is Section 92A. There is subsection 1 out here, and then there is subsection 2 in Income Tax Act of Section 92A. We'll start with Section 92A1 of the Income Tax Act. Now, Section 92A1 has a very generic definition of what is going to be associated enterprises. So, it's going to talk about what is generally an associated enterprise. Well, it says, if you look at Section 92A, subsection 1 of the Income Tax Act, it says that, listen, when there is one enterprise, when there is one entity, and it participates in the management, control, and capital of another enterprise, then these two enterprises will become related to each other. That means that if there is any enterprise and it is participating in the management. How can you participate in the management? Well, I'm going to talk about that. If you're participating in the capital, as in if you're holding share capital in the other enterprise, or if you're controlling the other enterprise in some manner, then these two enterprises will become related to each other. Now, what exactly is the meaning of management? What exactly is the meaning of capital? What exactly is the meaning of control? Well, I must tell you that Indian Income Tax Act does not define these three terms. So you'll have to look at, case laws out there to see what exactly is the meaning of management, control, and capital, generally, but these terms are not defined under the Income Tax Act. So, we'll make use of case laws here and there so as to see, what exactly are the meaning. But Section 92A is a very, very generic definition. It's a very, general, and it just says that if one enterprise as in a company A participates in the management, control, or capital of another enterprise, then it's going to become related to each other. These two enterprises will become related to each other. And what happens if they're related to each other? Well, transfer pricing provisions will be applicable, and you'll have to make sure that these two enterprises are transacting at something called arm's length price. Now, I'm going to give you a few examples, and I will talk about the meaning of these two terms also. Let's see example 1 here. There is company A, and company A is participating in the management, control, and capital of company B. How they participate, I'm going to talk about that. But let's just say that they're participating in some manner, or they're controlling company B. So if company A is somehow controlling company B by participating in its management, or participating, holding share capital, or controlling in any other manner, then they say that company A and company B will become related to each other, and they become associated enterprises. They also say that it's not just direct participation that we're looking at, even if they're indirectly participating in the other company. So if company A, through an intermediary, it is participating in the management, control, and capital of company B, well, then also these two companies will become related to each other. I'm going to give you another example of this also very, very soon in the next slide. But it says that if company A, it is participating indirectly through an intermediary in the management, control, and capital of company B, then company A and company B will become related to each other, or they will become associated enterprises by virtue of section 92A1. This is the first step. Section 92A1 also says that if there is a same individual, or there is a same person, and this person is participating in the management, control, and capital of company 1, and this same person is participating in the management, control, and capital of company 2, well, then company 1 and company 2 will become related to each other, and company 1 and company 2 will become associated enterprises because they have a common control. This common control, or this common person, is basically the same person. Let's take an example. Let's say that there is a director. This person is a director, or let's say that this person is a shareholder. This person is holding, say, for example, 50% share capital in company 1. And this same person is holding 50% share capital in company 2. Well, then, because they have a common shareholder, company 1 and company 2 will become associated to each other. But I'm going to give you more examples. I'm going to give you, more criteria on how they will become, associated to each other. But is this much clear right now? This is how two companies become related to each other. Let's take another example here, which is example on slide 27. In this particular situation, let's say that there is a company A Limited, and it participates in the management, control, and capital of company B. There is a direct participation. Then company B directly participates in the management, control, and capital of company C. So company A participates in company B, and company B has direct participation in company C. Well, then, by virtue of section 92A1, company A is also indirectly participating in company C. And in this particular scenario, both company B and company C would be related to company A. Company B is related to company A because there is direct participation. Company A is directly participating in company B. Company B is associated to company C because they are directly participating. And because company A has direct participation with company B, which is directly related to company C, that means company A is indirectly related to company C, and hence company A and company C would also be associated enterprises by virtue of section 92A. What I'm really trying to say is that it is not just direct participation that, the Income Tax Act is looking for, but even if company A is indirectly participating in company C through an intermediary in between, well, then also company A and company C would be associated to each other. So this is what section 92A1 really says. But does that not mean that then any and every company in the world would be related to each other? I mean, this is so, generic that you would see that there will be so many related party situations out there. There is a percentage, there is direct percentage of, shareholding, etc. I'm going to talk about that. That's all provided in section 92A2. I'm going to talk about that. But this is, the general clauses which are provided in section 92A1. Income Tax Act, as I mentioned, does not define what is the meaning of capital, what is the meaning of management, what is the meaning of control. It does not give a direct meaning of these particular terms, but this is what 92A1 says, that if they are, related to each other because they are participating in management, control, and capital of the another company. So this is what section 92A1 really talks about. Then, because this was not enough, if you see, there is section 92A2 also. And section 92A2, which is subsection 2, it starts with for the purposes of subsection 1, as in 92A. It says that two enterprises will be deemed to be associated enterprises if in any previous year there are these conditions which are listed there. So if you look at section 92A subsection 2, the Income Tax Act lists down 13 conditions out there. And they say that if these 13 conditions are met, if any of these particular 13 conditions are met, even if one condition is met, throughout the entire year, then these two companies will be deemed as associated to each other. What I've done is these 13 instances, if you open the Income Tax Act right now, there are these 13 instances which are provided in the Income Tax Act. What I've done is, because these 13 conditions are very, very difficult to remember, I have divided these 13 conditions into 3 categories. These 3 categories are capital, management, and control. I'm going to talk about these 3 categories, separately, but it's not provided. These categories are not provided in the Income Tax Act. In the Income Tax Act, you will just see 13 instances being provided, but I have just divided them so that it's easier for you guys to, remember. So section 92A1, if you open the Income Tax Act, is very, very generic. And it says that, these are, if they participate in the management, control, and capital, they will become associated to each other. Section 92A subsection 2 is very, very specific. It has listed down these 13 instances out there. And it says that even if you fall under one instance, we'll call you associated enterprises. Now, the point is, what are these 13 instances? But is it clear till now? Okay. So we'll go into the first instance. What is section 92A2 first talk about? What is the first instance, that they have provided? The first instance is this, which is provided under section 92A2A, which is, they say that two enterprises shall be deemed to be associated enterprise if at any time during the year there is direct or indirect shareholding of 26% or more voting power. So they basically mean to say that if one enterprise participates in 26% or more voting power in the other enterprise, well, then these two enterprises will be deemed associated to each other by virtue of section 92A subsection 2 clause A. They will be related to each other. How will they be related? Well, if they have more than 26% shareholding. But it's important to remember that law uses the word voting power. Do you think preference shareholding will count? What if one enterprise holds 27% preference share capital in the other enterprise? Will they be related to each other? Do you think preference share capital will count? Okay, I'll wait for that answer. I don't want to answer it. It says voting power, 26% or more voting power. So if one enterprise holds 27% preference share capital in the other enterprise, do you think they will be related to each other? Absolutely no, they will not be related to each other because the law says that there is voting power that we need. Voting power means equity share capital. So if one enterprise holds 26% or more than 26% equity share capital in the other enterprise, only then will these be associated to each other. Preference share capital does not have voting power, and hence they will not be related to each other, or they'll not be associated to each other. So we have to look at equity share capital in the other enterprise. There is a question on the chat box which basically says that do we have to check 92A1 and 92A2 both for determination, or 92A2 will override 92A1? Well, that is my question to you guys when we discuss all the 13 instances. After that, we'll discuss whether they will be associated, whether what is the overriding, or whether we'll have to check whether they will be related to each other, 92A1, 92A2, what is the relationship between them. We'll discuss that when we discuss all the instances. So that is my question, and we'll have a discussion on to that. But let's come back to 92A21. Let's take this particular example. A Limited holds 33% voting power in B Limited. So this is 33%, and B Limited holds 80% voting power in C Limited. When I say voting power, it means equity share capital. So in this particular situation, company A will be related to company B because it is 33% and 33% is more than 26%. So obviously it's related to each other. And company B holds 80% in company C, that is obviously more than 26%. So company B is also related to company C because it's more than 26% in its voting power. Then, because company A is related to company B and company B is related to company C, that means that company A is indirectly related to company C because there is an intermediary in between. So, meaning to say that they will all be related to each other. They are deemed associated to each other. And this is coming from section 92A2 because it says direct holding or even indirectly holding shares carrying 26% or more voting power. So in this particular situation, A is indirectly related to C company because there is indirect holding of more than 26% share capital. So this is what you have to look at. Now, section 92A2 talks about indirect shareholding of 26% voting power. 92A2B says that direct or indirect holding of shares carrying 26% or more voting power by same person in each enterprise. So even if there is one common person and this one person is holding more than 26% share capital in company 1 and it is holding more than 26% share capital in company 2, then these two companies will become related to each other. Meaning to say that if there is some Mr. A holds 40% voting power in company X and Mr. A holds 40% voting power in company Y. Please note that company X and company Y are not holding anything in each other. It is only company Mr. A holding 40% voting power in company X and Mr. A is holding 40% voting power in company Y. Well, then company X and company Y will become associated to each other. Well, that is because they have a common shareholding, which is Mr. A. And Mr. A is holding 40% here and 40% in Y. So X and Y will be related to each other. If this was a situation in which A is holding 40% in company X and A is holding 13% in, if A is holding 13% in company Y. Now, do you think will they be related to each other? Now, do you think X and Y is related to each other? Yes or no? Is X and Y related to each other in this situation now? No. Yes, absolutely. No, they are not related to each other. Well, that is because if you look at the law, it says 26% or more voting power. So only if it is more than 26% will they be related to each other. So these are two conditions, and these are the first two conditions of section 92A2. Now, the third condition is that if there is one enterprise which is providing loan of not less than 51% of the book value of the total assets. So if one enterprise gives a loan to the other enterprise and this loan is of 51% or more of the book value of the other enterprise, well, then these two enterprises will be related to each other. Let's take an example here. Let's say that there is some Y Limited, and this Y Limited has assets of 100 crores. So Y Limited, the book value of the assets, you will have to look at the balance sheet. The book value of the assets of Y Limited is 100 crores. Now, there is some X Limited that comes, and X Limited says that I will give you a loan of 60 crores to Y Limited. Well, then, because this loan is more than 51% of the book value of Y Limited, and X is actually giving a loan of more than 51%, which is 60 crores, well, then X and Y will become related to each other. That is because X has given loan of more than 51% or 51% or more than 51% to Y Limited. And hence, these are related to each other. X and Y would be deemed associated enterprises by virtue of section 92AC. Then there is section 92A2D, which says that guarantees not less than 10% of total borrowings. Now, what happens is, let's say there is a subsidiary company. Subsidiary company wants a loan from a company outside, or, from a bank. Subsidiary company wants a loan from a bank. Bank says that I will be able to give you that particular loan only if some company gives you a guarantee, gives me a guarantee that in case the subsidiary company or, the company basically defaults, then you will be there to repay that particular loan. So if another company gives a guarantee to the bank, on behalf of another company, and that guarantee is 10% or more, then these two companies will become related to each other. Let's take an example here. Let's say that there is some company called P Inc., which has a total loan of $1 million and it's taking it from XYZ Bank of America. So there is a P company and it's taking a loan of $1 million from Bank of America. For this particular purpose, A Limited steps in, some random Indian company, and this company says that I will give a guarantee to Bank of America that, if P company defaults on this particular loan, then I will give a guarantee of 20% of the total borrowings. Now, because A Limited is giving a guarantee of more than 10% to Bank of America, and they're giving it on behalf of P Incorporation, then P Inc. and A Limited will become related to each other. Well, that is because A Limited has given a guarantee of more than 10% of the loan, which is 20%, and hence P Inc. and A Limited will become related to each other by virtue of section 92A2D. The point is that, for all these purposes, for, the meaning of, the meaning of loan, meaning of guarantee is, in respect of borrowings and not any other guarantee, etc. For everything, what is the meaning of book value? It's all provided in the Income Tax Act. So you'll have to look at, what is, the book value of, as per, the accounting standards, what is the book value out there, and then make that particular decision on whether the book value is less or, more. All these calculations will have to be, made accordingly. But what exactly is the section is that we'll discuss, more examples on this particular concept. How do you calculate all these, situations? But as long as it is more than this particular threshold, it's going to become related to each other. So that is what is provided in section 92A, subsection 2 of the Income Tax Act. We've discussed four conditions, four instances right now, right here. And now we'll discuss, more. So if you look at these four conditions or, these four instances, sorry, not conditions. If you look at these four instances, These four instances were, to me, when I read these four instances for the first time, I thought that they were more inclined to capital. They were all talking about, capital shareholding, or, they were talking about loans and, guarantees. So out of these 13 instances, I divided these four into capital, but I would want to tell them that the Income Tax Act does not make that particular, categorization. I have only done that because I think that, it becomes easy to remember, but the Income Tax Act does not do that. So these are the four instances that we've discussed right now. Any questions on these four instances? Or should I, continue with the fifth instance? So these are the four that we've discussed on capital. Okay. Any question? So in my example out here, there is a question out here that in the example of A versus B versus C, what if C sells goods to A when C does not hold any share in A or B? So they're trying to say that what if C sells goods to A and C does not hold any share in B and it does not hold any share in A? Well, in this particular instance, transfer pricing provisions will not be applicable for now, but there is a situation of deemed international transaction. Till we discuss that situations, this particular situation will not be within the purview of transfer pricing. Well, that is because C is an unrelated party. C is not related to A, C is not related to B. So if A and C transact, they will transact at an open market price, and transfer pricing provisions will not be applicable. Please give an example of 13 instances. Well, the 13 instances out of 13 instances that I provided here, these were the 13 instances. If you open the Income Tax Act, out of these 13 instances, I have given 4 instances, right here. So let me actually share my screen to the Income Tax Act of 1961, and this will become more clear as I just display the section. So just allow me a minute, I'm displaying the section. Okay, so this is how Section 92A is worded. If you look at Section 92A, this is Section 92A1 that we've discussed through the slides, the generic section. And then Section 92A2 is what we are discussing. So within Section 92A2, we have discussed these 4 conditions right now. These 4 conditions says one enterprise holds share carrying 26% voting power in the other enterprise, or one person holds shares carrying not less than 26% voting power, loan advanced not less than 51%, and guarantee not less than 10% of the total borrowings. So this is what we've discussed, these 4 conditions. And now going forward, these are the rest of the conditions that we will now be discussing. So when I said 13 conditions, these are the 13 conditions from A to M that we will be discussing now. We have discussed the 4 right now. What else we need to discuss is the interplay between 92A1 and 92A2. We'll discuss that also when we are finished with all these 13 instances right here. So out of these 13 instances, now I'm going to the 5th instance, but these are the 13s that we will be discussing. I will go back to the slides now. Okay. So these are, the slides, that we were discussing. These are the 4 instances that we've discussed. And now we'll go to the 5th instance, right here. Okay. Any questions? Okay. Any questions now? Sir, I answered the question, which was, what if C does not hold any share in A and B? Okay. Okay, great. So now we will go to, now we will go to these 13 conditions, and now we'll go to the 5th condition, which is on something called management. So the 5th condition talks about section 92A2E and 92A2F. Now, this condition is very, very interesting. I have divided this condition into a terminology which is called management. And what does that mean? What do I mean when I say, management? Well, it just says that, if there is a company, and this company is actually appointing board of directors in the other company, or this one company is appointing executive directors in the other company, well, then these 2 companies will become related to each other. Meaning to say that, let's say there is one company, and this one company is appointing board of directors in the other company. How many board of directors? Well, more than half of the board of directors is appointed in the other company by the first company. Well, then these 2 companies will be related to each other. So the law says either you appoint more than half of board of directors, or you appoint one executive director or more than one executive director in the other company, or executive member in the other company. Well, then these 2 companies will become related to each other. And I think that's only wise. That's a very wise thing. So if you feel that one company is actually appointing, people in the other company, more than half of the board of directors in the other company, and these board of directors will actually do the decision making in the other company, then obviously these 2 companies will become related to each other. I think it's very logical also that these 2 companies should be associated, because one company is appointing executive directors, or one company is appointing more than half of the board of directors in the other company. Then it's only obvious that these companies will be associated to each other. And that's what section 92A2E actually says. So let's take an example here. Let's take the first example. X Limited has 15 directors on its board. Now, out of that, Y Limited has appointed 8 directors. That basically means that more than half, more than 7.5, which is 8, more than half is actually appointed by Y Limited. In such a case, X and Y will be deemed as associated to each other by virtue of section 92A2E. So the section says either you can appoint more than half of the board of directors, or you can appoint one or more executive director. So, if you talk about, there are these remuneration committees in a company, or there are these audit committees, etc. These are not included. What we are actually looking at is the board of directors in a particular company, and that will only be included in this particular situation. We're not looking at remuneration committees or, audit committees in different companies. Those are for a specific purpose. But if there is a board of directors, or there is a governing board in a company, and one company appoints board of directors, more than half of the board of directors in the other company, then they will become related to each other. Or even if there is one or more executive director. Now, the word that has been used by the law, it says executive director, or it says executive members. Do you think independent directors will be covered? So if one company appoints independent directors in the other company, do you think that will be covered, independent directors? Exactly. So the difference between executive directors and executive members is within the question, which is, do you think that independent directors will be covered? Appointment of KMP, yes, appointment of KMP, key managerial persons, that is what we're talking about. Absolutely. When we talk about independent directors will not be covered. What I've done is, this is the reason I have provided notes here. Independent directors are always non-executive directors. They help the company in improving the corporate credibility, in improving the governance standards. So when I say executive directors or when I say executive members, they will not be covered within the purview. So if one company appoints independent director in the other company, they will not be covered. That is fine. They will not become associated to each other. But only if they appoint executive directors or executive whole-time directors, etc., or members, executive members, as in KMP, then they will become related to each other. Exactly. Your answers are correct. Independent directors will not be covered. Now, section 92A to F is also similar. It says that even if there is one person and this one person is appointing more than half board of directors in one company, and the same person is appointing more than half board of directors in company 2, well, then company 1 and company 2 will become associated to each other. Similarly, if there is one person and this one person is appointing one executive director in company 1, and this person is appointing one executive member or director in company 2, well, then also company 1 and company 2 will become related to each other. That is what is provided by section 92A to F. So it says even if there is same person in both the enterprises, then also they will become related to each other. So there is an example out here which says Mr. A appoints 9 out of 15 directors in company X and 2 executive directors on the board of company Y. In this situation, do you think A is related to company X? Well, yes, A will be related to company X because out of 15 board of directors, 9 are directors appointed by Mr. A. So that means Mr. A will be related to company X, more than half board of directors. Then the same person, Mr. A, has appointed 2 executive directors in company Y. Well, A will be related to company Y. And because there is a common person A, that means company X and company Y will also be related to each other by virtue of section 92A to F. Because there is same person who is appointing people in both the companies. So this is the reason, because the law is worded in that particular manner that, you're appointing people in the management of the other company. I have divided these two sections into the terminology management. So if there is, appointment in more than half board of directors or one or more executive directors, they will become associated to each other. So in this particular situation, the companies will become associated to each other. So these were the conditions on management. Please repeat 92A to F. Okay, I will repeat 92A to F. 92A to F basically means that there is one person and this one person is appointing people in 2 companies, meaning to say this kind of situation. This kind of situation. There is one person, this same person, and this person is in company 1, they are appointing, company 1 has 15 board of directors. Out of 15 board of directors, this person has appointed 9 of them. That means this person is related to company 1 because out of half of the board of directors, this person has appointed 9. So in 15, they have appointed more than half, which is 9. So that means this person is related to company 1. Now this person also appoints 2 executive members in company 2. So the law says that if you appoint more than 1, you will be related to each other. This person appoints 2 executive members in company 2. That means that this person has appointed people in company 1 and the same person has appointed people in company 2. That basically means that by virtue of section 92A to F, company 1 and company 2 will be related to each other. This is what section 92A to F basically defines. Okay. Any other question? This is provided in management. You can go through these examples, these 2 examples on this slide out here. And now we have completed 6 instances, which are, provided in section 92A2. It's not a very big deal for, people to appoint directors in the other, company. Practically, also this happens that appointment is made. Maybe there is common shareholding. This particular person has a lot of, control in two enterprises. So if there is one person which has practically, I've seen instances wherein one person has a lot of control in two enterprises. Maybe there is, a shareholding in such a manner. So if one shareholder appoints people in the other enterprise, well, then this situation basically rises and they become related to each other. So it is very, very possible for one person to have a lot of influence or control in the other enterprise by virtue of section 92A1. So as to appoint people, so as to appoint directors in two enterprises, and they become related to each other. So it's basically a mix of, it's just basically a mix of influence and control and shareholding all put together. That is where relationship basically exists, and two enterprises become related to each other. The next few instances are instances which I've divided into control, which basically says 92A2G, which basically says that if there is complete dependence on intangibles for manufacturing, processing, or for business. That basically means that, let's say there is a company and this company is manufacturing a watch. Now, this company is able to manufacture this particular watch only because it is getting an intangible, which is basically a trademark or a know-how. And this particular know-how is actually, legally owned by company 2. So company 1 is actually selling watches, and company 1 is able to sell watches because it is dependent on the intangible that it is procuring from company 2. Company 2 owns that particular intangible. So company 1's business is completely dependent on this intangible, which is held by company 2. Well, if this is the situation, then section 92A2G says that company 1 and company 2 will become related to each other or associated to each other. So that is what is provided in section 92A2G. But I'd suggest please read through the entire section, because I have provided the entire language of the section out here. But I'd suggest that, you also read through the entire section, the entire word, because it uses words like wholly dependent. So we're looking at 100% dependency on the know-how and, patents, trademarks, etc. So it's provided out here. And you have to make sure that company 2 is the owner of these particular intangibles. So then these two enterprises will be related to each other. The meaning of intangibles is provided in section 92B, and we'll, read through that also. But that is section 92A2G. Now, section 92A2H says that if one company is supplying raw materials to the other company and the prices and other conditions relating to such supply are influenced by the other enterprise. So that basically means that if one company is supplying raw material to the other enterprise and this raw material supply is 90% or more. So 90% of the raw materials that are procured by this enterprise are supplied by one enterprise. Well, then they are related to each other. Because the thing is that if this one enterprise stops giving them raw material, then this business will come to an end. So this one enterprise which is supplying raw material 90% or more is controlling the other enterprise in such a manner that the entire business of this enterprise is dependent on them. So there is a relationship of control, and hence law says that if you are supplying more than 90% of the raw material to the other enterprise, then they will become related to each other. The next one is section 92A2I, and it says that if there are goods manufactured or processed by one enterprise and they are sold to the other enterprise, and prices and conditions relating to that transaction are influenced by the other enterprise. That basically means that if I am processing some goods and I'm manufacturing those particular goods and I'm selling all those goods manufactured to another enterprise, well, then and the prices are also determined by these two enterprises, well, then there is a definition of control and these two are associated enterprise. Now, section 92A2I is so widely worded because there are so many transactions between enterprises, and wherein, one enterprise just delivers all the goods manufactured to the other enterprise, well, then they become associated to each other. So yes, it is not, very vague. A lot of enterprises come within the purview of section 92A2I because the law is worded in that particular manner that if you're actually giving all the goods to another enterprise, all the manufactured or processed by one enterprise are sold to the other enterprise, then they will become related to each other. The point is, there is a lot of litigation on in India on how two enterprises become related to each other, because the meaning of the terms are not defined. Prices and such other conditions relating thereto are influenced by the other enterprise. Now, these are such widely worded terms. What do you mean by influenced by the other enterprise, etc.? So there are case laws, there are decided case laws that we rely on so as to understand what exactly are the meaning of these particular terms. But this is what the law really says. So if you look at, these three conditions, you will understand that in terms of transaction between two enterprises, there is a lot of control that exists. If you're supplying raw materials or if your manufacturer is actually dependent on someone else's intangible, they will become related to each other. So there's a lot of control which is involved. And hence they say that these two enterprises will become related to each other because there is a lot of control between them. Section 92A2J says that if there is common control by individual and or relative. So if one individual is actually holding one company, and you would actually see in a lot of practical scenarios that if one individual is holding or, is controlling one company and they have their own relative which is controlling another company, well, then these two companies will also become related to each other. Practically, I've seen a lot of scenarios wherein one brother is shareholder 26% or more in one company, and this particular individual's brother is holding another company, is like a shareholder in another company. Well, then these two companies also become related to each other. Well, that is because there is a common control by this individual and their relative. So if one brother is holding one company, another brother is holding another company. Now, because they are relative by virtue of Income Tax Act, the two companies also become related to each other. So that is what is provided by section 92A2J. K is also very similar. It says that if HUF is holding, one company and the member of the HUF or the relative is holding another company, well, then they also become related to each other. Then in case of firm AOP holding of 10% or more interest in another company, that will also become, related. And finally, there is section 92A2M, which says relationship of mutual interest as may be prescribed. Nothing has been prescribed by CBDT as yet. So they will also become related to each other. What I'm going to do is for these sections, I'm going to give you one example to explain how is relationship determined by virtue of these three sections. Yes. The definition of relative is, explained in the Income Tax Act itself. You can go to the definition of relative, but generally, brother, sister, spouse, etc., are covered within the definition of relative. The relative of definition, it's not very specific to transfer pricing. The definition of relative, which holds true for Income Tax Act, is actually applicable in this particular situation also. Let's take this particular example and then I will go back to all the questions. Meanwhile, you can drop your questions and I'm going to answer those questions after I discuss these two examples. Now, HUF controls A Limited, and there is a member of the HUF or the relative of this particular member of the HUF. So let's say there is this particular HUF and then there is a co-partner of this particular HUF. The HUF controls A Limited, and the member of this particular HUF controls B Limited. Now, what do you think? Would A and B be related to each other or be associated enterprises? Please drop your answers in the chat box. Yes, absolutely. A and B will be related to each other. Why will they be related to each other? Well, if you look at this particular section, it is common control by HUF and or by its member or relative. So if there is common control and this common control is by the HUF and its relative, both of them are together holding A and B. HUF is controlling A and member is controlling B. Now, because these two are related to each other, A and B will also be related to each other because there is common control by virtue of section 92A to K. Yes, they will be deemed associated enterprises. Another question, let's say this particular question. A is the managing director who controls a company, and the managing director's daughter holds 50% share capital in another company. What do you think? Will the companies be related to each other? So managing director controls one company. The managing director's daughter controls another company and holds 50% share capital in another company. Do you think these two companies will be related to each other? Please answer this one, then I will summarize uh, the control slide. Yes, they will be related to each other. Why will they be related to each other? Well, that is because the section says common control by individual and or relative. So individual is the managing director controlling one company, and the managing director's relative, because daughter is a relative for the purposes of Income Tax Act, they are controlling another company. So these two companies will also be related to each other because of common control. So this is, the situation. Yes, the daughter is controlling another company because they are holding 50% or more, which is more than 26% share capital. So they are also controlling another company, and hence they will be related to each other. Now, if you look at, like a summary of these control conditions, I do understand that they are very difficult to absorb because, they are not as specific as all these definitions. So, management was very specific. Even if you look at the capital one, it was very specific because they said 26%, 51%, 10%. But if you look at these definitions of control, these are not very, specific, and hence it might become a little difficult to understand them. And this is the reason that there is a lot of litigation in the country on what is the definition of control for the purposes of Income Tax Act transfer pricing. There's a lot of litigation, but it just says that, if someone is selling some product and this sale is dependent on intangible that they have procured from another company, or someone is selling this particular product, and for selling this product they are getting raw materials, 90% of the raw material from another company, or there is one enterprise and they're manufacturing and they're selling all their manufactured goods to another company, like everything to another company. Well, then these companies will be related to each other, because if you see that their business is dependent on the other enterprise. If the other enterprise says no, their business will come to an end. So they are, in other words, controlled by the other enterprise, and hence they have provided these particular instances out there that if these instances are established, then two enterprises will become related to each other. That is what is defined under these particular instances right here. What you will have to do is, look at the entire section, because what I've done is these are not the language that is provided in the law. So I would suggest that, you look at the language which is provided in section 92A2B, 92A2. And if you have any questions, we can discuss them after that. But I would suggest go through the language of the law first. There was another question which basically said that what is the definition of relative? As I mentioned, the definition of relative is provided in the Income Tax Act. And yes, appointment of one or more executive director, more than half only for directors or KMP. So, you have to understand that when it talks about board of directors or the governing board, then it is more than half. But when they talk about executive directors or executive members, even one can constitute associated enterprises. So when it comes to board of directors, half, more than half, more than 50%. And when it comes to executive directors, it is one or more. So that is the condition. So appointment of, I can put it like this, more than half board of directors or one or more executive directors or members. So when it comes to board of directors, it is more than 50%, or when it comes to executive directors or members, it is one or more. Please let me know if there are more questions on this. Oh, so the difference between executive directors and executive members is, just the difference between key managerial person and director. A director is, an executive director that is responsible for, that is holding directorship in a company. Executive members can include, the key managerial persons out there. So this is basically the difference between a director and a member general. A member general can be the KMP also, that is. Now we get on to another concept, which is what happens if someone follows 92A1 but does not follow 92A2. So that basically means that, let's take a situation that there are two companies. Okay. There are two companies, and this company is participating in the management, control, and capital of another company. That means this company is following 92A1. It is participating in the management, control, and capital, and it is somehow controlling the other company because it is there in 92A1, and 92A1 is very general. But when you look at these specific instances, these 92A2 conditions or instances, these two companies are not following these two instances. Now what happens? Do you think they are associated to each other or not? Do you think they are associated to each other or not? They are following 92A1, but they are not following 92A2. Well, there are, a lot of case laws out there, so I cannot conclusively say, whether they are related to each other or not. But the thing is that if you look at the language of the law, if you look at section 92A2, it says for the purposes of subsection 1. So when they say for the purposes of subsection 1, that basically means that they are interrelated to each other. But at the same time, there are Karnataka High Court decisions. There is a condition, there is a case law which is called Page Industries, wherein they say that, these two have to be related. But then there are also case laws wherein they say that no, even if they are not following each other, even if someone follows 92A1 but is not specifically covered in 92A2, then they will not be related to each other. They will be related to each other. There are conditions, there are case laws both the sides. But then if you look at the law, it says for the purposes of subsection 1. So that basically means that 92A21 and 92A22 both have to be followed. Further, if you also look at, Form 3CEB, which is the transfer pricing return, under that, they specifically, there is a mandatory field here that, if you think that two enterprises are related to each other, by virtue of which section. So it says by virtue of which instance are they related to each other. And that basically somehow signals that it is mandatory to follow 92A2 if you want two enterprises to be related to each other. So, but, then there are, case laws both the sides, and I cannot conclusively say, which exactly condition is to be followed, or which, whether there is an interplay between the two or not. But if you look at practically, we always make sure that all the enterprises are following 92A2 to be related to each other, because we have to put them under which section are they related, under the transfer pricing return, and we can do that only if they are related under 92A2 too. So we have to follow 92A2. Okay, any question? Well, yes, 92A to 92A1 is to be followed, and then you can see 92A2 which one is to be followed. But I somehow feel that it's mandatory to follow 92A2 somehow. The next situation is that, now that I know that two enterprises are related to each other, now the next thing is to identify, is the transaction that they are entering into, is this an international transaction or not? And the definition of international transaction is provided in Section 92B of the Income Tax Act. So now what is 92B2? 92B, sorry. 92B says that transactions between two or more associated enterprises, either or both of whom are non-residents, will be called an international transaction, and these are the transactions that they have identified. These transactions are what is provided in 92B. Now, the thing is that one party has to be a non-resident and the other is a non-resident or a resident, it does not matter. But at least one party has to be a non-resident. But at the same time, I'm going to make this clear as we go forward and we discuss this concept on deemed international transaction. I'm going to come back to that. But for now, it says that international transaction are these transactions, and these are provided in Section 92B. So the point is, what are these transactions? Well, they say that if two enterprises are transacting with respect to a tangible property, well, then this is going to be called as an international transaction. Let's say, what exactly are these, transactions between tangible property? Well, these can be any transactions. So, if one enterprise is selling any tangible property, building, vehicle, materials, or, many machinery, plant and machinery, laptop, any article, any tangible property that is being sold to another enterprise, well, then they become, this is an international transaction. It could be a sale transaction, it could be a purchase transaction, even this is a lease transaction, even if it is a transfer transaction, etc. They're very widely worded, and all these transactions will be within the purview of an international transaction. Then they say that even if it is not a tangible property, even if it is an intangible property, the meaning of intangible property is very, very wide. It's provided in Section 92B2 of the Income Tax Act. It's also provided in the course manual, in the study manual, ICAI. You can either look at Section 92B2 or the study manual. The definition of intangible property is provided here in that particular instance, and it's very, very widely worded. So intangible property would be in the nature of, trademarks, patents, know-how, etc. All these commercial rights, ownership rights, etc. These are intangible property. So even if one enterprise is actually selling their intangible property, selling their patents to another enterprise, that is going to be an international transaction. Even if there is a sale transaction, or they're purchasing intangible property, or they're leasing intangible property, that's all considered as an intangible property transaction, and they'll be considered as an international transaction. Then international transaction is very widely worded, and they say that even if one enterprise is providing a loan to another enterprise, so if parent entity is giving loan to the subsidiary company, this is also an international transaction. If parent entity is giving a guarantee to a bank on behalf of the subsidiary company, well, this is also an international transaction. If you are purchasing shares of, the subsidiary company, that's an international transaction. To the extent that you would always see that there are some account receivables, outstanding payables at the end of the year, even that is considered as an international transaction for the purposes of Section 92B. Well, because the language of the section is worded that even if there are advances, even if there are receivables, even if there are payables which are occurring out of a particular transaction, even those year-end balances between two enterprises, related enterprises, that will also be considered as an international transaction by virtue of section 92B. Then, even if one enterprise is providing services to the other enterprise, so, if there is technical service which is provided, a lot of times you would see that, Indian enterprise provides IT services to an enterprise in the USA. Well, this is also an international transaction. There is a lot of times that the subsidiary company provides accounting services to the parent company. Well, this is also an international transaction for the purposes of section 92B. And finally, they say that even if there is a business restructuring transaction, so, if there is a transaction where the parent entity is buying another entity, or there is some kind of business reorganization or business restructuring that is happening, there is a manufacturing company and it's converting itself into a distribution company, then there is an entire reorganization of the entire company. That will also be a transaction that will be called as international, transaction for the purposes of Income Tax Act. So even if there is a demerger transaction or two entities are merging to form another, one whole entity, that will also be considered as an international transaction for the purposes of section 92B. This is the language of the section. You can actually look into this particular section. I have provided the language of the section right here, but this is the shorter form. I've just summarized the section for you guys. Section 92F, as I mentioned, talks about the meaning of the term transaction. Now, the transaction meaning is basically meaning an arrangement or an understanding, whether it is in writing or it is enforceable by legal proceedings, it does not matter. Meaning to say that, the meaning of the term transaction is also so widely worded that even if it is a transaction and it's not properly documented, there is not like a formal written agreement to it, but even if the transaction has, legal enforceability or it does not have legal enforceability, it's still going to be a transaction. So it's a very, very widely worded, format. Meaning to say that if there is a transaction between parent entity and a subsidiary company, and this transaction is not documented properly in a written agreement, there is no intercompany agreement that exists, but still this will be considered as a transaction for the purposes of section 92F, and this will be considered as an international transaction, and transfer pricing provisions will apply. Meaning to say that if there are two associated enterprises and they do not have an intercompany agreement, but they still transact, and this transaction is appearing in the accounts, in the balance sheet, in the P&L account, etc. And even if there is no intercompany agreement between them, this will still qualify as an international transaction, and transfer pricing provisions will apply onto this particular transaction. 92, I have a question on the chat box which says 92B seems to be a repeat of 92A2. Well, it is not a repeat because section 92A2 basically says that when will these two enterprises become related to each other. But 92B defines what are the kind of transaction. So, in 92A, they say that yes, this enterprise and this enterprise, they will become associated to each other. But 92B says what are the kind of transaction that will happen. Is this a purchase transaction? Is this a sale transaction? What kind of, is this a, borrowing transaction? Is it a guarantee transaction? So they're just saying that these transactions will be within the purview. The problem arose because, a lot of people said that when there was an issue of share transaction, or, a lot of people said that when there are outstanding balances given in the year-end balance sheet, they say that this is not like a transaction. You don't have to report it. You don't have to make sure that this is at arm's length. But this is where section 92B specifically wrote that no, these transactions will be within the purview of transfer pricing because these are considered as a valid transaction. So, as chartered accountants, we would say that if these are year-end balances, this is not really a transaction. They're just balances at the end of the year that are reflecting in the balance sheet. These are not really a transaction. But this is where 92B says that no, year-end balances, outstanding receivables, outstanding payables are also transactions, international transaction by virtue of section 92B, and you'll have to make sure that these are also at arm's length price. Now, how do you make sure that these are at arm's length price? That is for the next lecture to discuss. We'll use the methods out there, but this is what basically section 92B really says. Any other question? Okay. Any other question before we move to a very, very interesting topic and the last topic for today, which is deemed international transaction? Any other question out here? Okay, I'm just looking at questions, waiting if there are any questions. Okay, so as to summarize, there is a question out there. There is a request out there to summarize section 92B. Well, as a summary to section 92B, it just says that 92B has listed down what are the kind of transaction that can happen between two enterprises. What are the nature of transaction? So the law says, section 92B says that if there are any random purchase sale transaction, and these could be any transaction, building, vehicle, machinery transaction, or one enterprise is buying patents in the other enterprise, or one enterprise is using patents of the other enterprise, or if there are one enterprise giving loan to the other enterprise, or there are provision of services between the two enterprise, then these will be considered as an international transaction. This section came into place because a lot of people said that no, this is not considered as a transaction. Section 92F actually came into place because a lot of people actually said that this particular transaction was not documented, or there was no intercompany agreement. This particular transaction between two enterprises was not formal. There was not a written agreement, and hence this should not be considered as an international transaction because it's not provided in formal writing. And this is the reason 92F came into place, and they said that even if it is not provided in writing specifically, or these particular transactions are there or not, then still they will be considered as international transaction. So a lot of people started saying that listen, parent company is giving a guarantee to a bank on behalf of the subsidiary company. They said that this is not really a transaction because, there are no amounts that are exchanged. They're just giving a guarantee that in case a default happens, then the parent company will repay for the subsidiary company. So they said that this is not really an international transaction and transfer pricing provisions should not apply. That is where section 92B and section 92F came into place. And they said that the law specifically said that these will be an international transaction. And the moment that these kind of transactions happen, you will have to make sure that they are happening at arm's length price. So when a particular transaction happens, there is a question out here which says when any transaction done, then first, do we have to find out associated enterprise or international transaction? How we basically identify. So what practically we do is we first find out whether whether they are an associated enterprise or not. When they are an associated enterprise, then we see whether there is a transaction between them or not, because both the conditions have to be satisfied for transfer pricing provisions to apply. So that is what we have to find out. Alternatively, you can actually look at what we do practically is we look at the balance sheet. We took the entire annual report. We look at AS 18. They have related party transaction. So we directly go to the related party transaction, and then we see that what are the related parties and by virtue of which section in 92A are they related. And then the second step, we see that what are the transactions? Are these transactions that are there by virtue of section 92B? And when both these conditions are satisfied, we actually report them in the transfer pricing return. So this is what you have to do practically. But as far as the examination point of view is concerned, you have to first identify whether they're related or not, associated, and then see whether this is an international transaction or not. So you have to identify both the things. Okay, let's go to the next topic, which is a very, very interesting topic, which is called deemed international transaction. Now you have to be a little more attentive right now because it's a little technical concept right here. Now let's take this example so as to understand deemed international transaction. This deemed international transaction is provided in section 92B2 of the Income Tax Act. Now let's look at this particular situation. Let's say there is a foreign associated enterprise. Okay, there is some foreign company. And then there is an Indian company. So what we have is this Indian company right here. And this Indian company has an associated enterprise and it's in some foreign jurisdictions, let's say UK. So there is an Indian company and it has an associated enterprise in the UK. Now the thing is that if these two enterprises, Indian and UK enterprise, they transact with each other and they have a transaction, obviously transfer pricing provisions will be applicable. Why transfer pricing provisions will be applicable? Because one, they are associated to each other. Okay. And second, this is an international transaction because one entity is in India and the other entity is in the UK. So both the conditions are satisfied. They're associated to each other and they are international transaction is there. So if these two transact, transfer pricing provisions will be applicable and they will have to make sure that they are interacting at something called arm's length price. So what is the, what the device is, they said that we don't want to do that. So what they thought about was, they said that let's have an unrelated party here. So Indian enterprise has an unrelated party here. When I say unrelated, as in they're not related to each other. So they decide that let's have the Indian enterprise transact with this unrelated party. And what will happen if this Indian enterprise actually gets into a transaction with the unrelated party? Well, transfer pricing provisions will not be applicable. Well, because they are not related to each other. But they decided that for this particular transaction between the Indian enterprise and the unrelated person, all the terms of the transaction, like, the price at which they are transacting and other terms and conditions of this particular transaction, that will be determined by the foreign enterprise. I'm saying that again, Indian enterprise will transact with the unrelated party, but this particular transaction, at what price will this happen? When will this happen? That will be determined by foreign associated enterprise. That means that, everything is determined by the foreign associated enterprise. They've just gotten an unrelated party into place so as to circumvent transfer pricing provisions. So in this particular situation, the CBDT came up with section 92B2 and they said that if the Indian enterprise transacts with this unrelated person and we get to know that this particular transaction, the terms of this particular transaction was undertaken by the foreign associated enterprise, well then we'll call the transaction between Indian enterprise and the unrelated person, we'll call this a deemed international transaction. So they said that we know that this particular transaction is not between two related parties and this should not be an international transaction, but because the terms of this particular transaction are determined by the foreign associated enterprise, we're going to call this particular transaction also as an international transaction, and transfer pricing provisions will be applicable on this transaction between the Indian enterprise and the unrelated person, because we'll call it a deemed international transaction. So they said that we know that this is not an international transaction, but we'll call it a deemed international transaction. And even within this particular transaction between the Indian enterprise and the unrelated person, even transfer pricing provisions will be applicable here. So this is a deemed international transaction. They were transacting with this unrelated person so as to circumvent the law. They did not want to transact at ALP. They were circumventing the law. And this is the reason CBDT said that no, this will be called as a deemed international transaction, because you're not really interacting with each other. There is a foreign associated enterprise, and that is determining how they are transacting with each other. So that is the concept of deemed international transaction. Shall I explain it again? Please answer it on the chat box and I can explain it again. You can take a minute to go through deemed international transaction. It's provided in section 92B2. Okay, I will explain this again. So now what happened was, there was an Indian company, and this Indian company had a foreign AE. Now, Indian company said that if we both interact with each other, or if we both transact with each other, we'll have to make sure that this transaction is at ALP. Transfer pricing provisions will be applicable. And that is because, one, this is a related party transaction, because, Indian enterprise has an AE, and this is an international transaction because this is a resident and this is a non-resident. So they said that, transfer pricing provisions will be applicable. So this Indian enterprise and foreign enterprise, they said that let's have the Indian enterprise transact with an unrelated person. Because if they transact with an unrelated person, obviously transfer pricing provisions will not be applicable. But they got confused. They said that, listen, you as an Indian enterprise interact with this unrelated person, and whatever is the price, that will be dictated by the foreign associated enterprise. The price at which the Indian enterprise transacts with this unrelated person, that will be determined by the foreign associated enterprise. So they said that, we'll just sort of fool the law by having this in place, because in substance, the transaction is happening between us because we are determining the price. But so as to circumvent transfer pricing provisions, we'll just put an unrelated person into place. Nothing is happening with the unrelated person. Everything relating to this particular transaction, the terms of the transaction, this transaction is actually being determined by the foreign associated enterprise. But because they wanted to circumvent the law, they got an unrelated person into place. And this is where section 92B2 comes into play. And they say that if we see a situation wherein transaction is happening between two unrelated persons, but the terms of the transactions are determined by this foreign AE, foreign person who's associated, well, then we will call this particular transaction as a deemed international transaction, and transfer pricing provisions will be applicable on this particular transaction. Okay. Any questions here? Now, is it sounding better now? What we can do is, let's take this with the help. This is where, I've provided the law out here, section 92B2. This is the law. If you read this particular law, it's very, very confusing. But if you read this in sync with this particular example, it will become very clear. So read through this particular law, and let's take an example out here, which is this particular example. Let's say that there is A Limited. Okay, this A Limited is an Indian company. And this A Limited actually gets into an agreement for sale of product X with B Limited. Now, B Limited is an unrelated party. So A Limited says that I'm going to sell my product X and I will sell it to Mr. B. The thing is that A Limited and Mr. B are, not related to each other. Okay. So this is fine because they are not related to each other. Transfer pricing provisions will not be applicable. Now, the second step of this transaction is that A Limited holds 27% voting power in C Inc. C Inc. is an associated enterprise of A Limited because A Limited is actually related to C Inc. holding 27% voting power. Now, the transaction is that A Limited is actually selling to Mr. B, which is an unrelated party, and transfer pricing provisions will not be applicable. Now, what happens is that B Limited actually enters into an agreement of sale of product X with C. So A sells to B and B says that I'm going to be selling it to Mr. C. Now, if you see that A sells to Mr. B and this is not related, this is a transaction which is not related, and B sells to C. And A is actually related to C and it is an associated enterprise. So in this particular situation, they are trying to say that A Limited this will be a deemed international transaction between A and B, because I do understand that they are not related to each other. But do you see that A is actually related to C and B is actually selling to C? So they are doing this particular transaction between A and B because they want to circumvent the law. So so A and B, they enter into a deemed international transaction. I do understand that they are not related to each other, but they will still be considered as a deemed international transaction because A is related to C and B is selling to C. So this will be considered as a deemed international transaction between A and B, while even they are not related to each other. Well, that is because they are transacting with each other because they wanted to circumvent the law. Meaning to say that if you look at a transaction of deemed international transaction, you have to look at, even if there are three parties involved, you have to look at the reasoning of the law. Are they trying to circumvent the law by transacting with an unrelated person, or are they just interacting with each other in the ordinary course of business? If you feel that they are interacting in the ordinary course of business, it's fine. But then if you see that Indian enterprise is transacting with the unrelated person and the terms of the transaction are determined by a foreign associated enterprise, well, then this will be within the purview of deemed international transaction, because their intention was not to transact with each other. Their intention was to circumvent transfer pricing provisions in that manner, and hence they will be deemed international transaction even if they are not related to each other. Well, what is written out here is prior agreement. I'm just zooming in because there is a request. Prior agreement in relation to relevant transaction or determination of terms of the transaction in substance. Meaning to say that even if they are, this particular transaction between Indian enterprise and unrelated party, even if there is, a prior agreement that we will decide the price, you transact, you Indian enterprise and unrelated party, you guys transact, but we will determine the price in substance, or the terms of the transaction and how you are transacting, we will determine. Well, then this particular transaction will be a deemed international transaction. Even if you don't understand it here, please look at the law. The law is worded in a manner, this is provided in the law. So I've just copied it, prior agreement and terms of the transaction. I've just copied it from the law itself. So you can look at, the law itself. I am coming to that. It will be difficult for the department to find out deemed international transaction. For deemed international transaction, you need, intercompany agreements. It's kind of substance over form. That's absolutely correctly mentioned in the chat box. It is substance over form, and it will be difficult for, the parties to actually determine it. But yes, it will be, deemed international transaction. It just depends on intercompany agreements, and you'll have to, for the department also, they'll have to look at all these intercompany agreements on how the transaction is determined, on how the price is determined, etc. And then they'll be able to understand that this was a deemed international transaction. Another thing that I wanted to point out was that even if these two enterprises are Indian enterprise, even that will be considered as a deemed international transaction. Meaning to say that if this unrelated person, even if it is in India or if it is outside India, if this Indian enterprise or if this is non-Indian enterprise, if this is a resident Indian or this is a non-resident Indian, it does not matter. So even if this enterprise, Indian enterprise, and this is also an Indian enterprise, I do understand that this is a domestic transaction between two Indian enterprise, but still it's going to be a deemed international transaction. So they say that whether the unrelated person is an resident or non-resident, it does not really matter. So it says whether such other person is a resident or a non-resident, it does not really matter. So even if it was a transaction between two Indian enterprise, it would have been within the purview of an international transaction. It would be a deemed international transaction. Please let me know if you have any questions. And with this, we come to an end of our presentation here. What we've discussed is all the basic concepts in transfer pricing. So we've discussed, what was the need to have transfer pricing using those two diagrams. We discussed some key terms on what is a controlled transaction, what is an uncontrolled transaction. We also discussed, the Indian transfer pricing regulations, what makes two enterprises as associated enterprises, what is an international transaction, what is a deemed international transaction, and these are really the basic concepts. In the next lecture, we'll again be discussing transfer pricing, but we'll discuss how do you compute arm's length price. So we'll be focusing on those. So now that we know that two enterprises are associated to each other, because we've discussed the rules out there, we know that this is an international transaction because we discussed the rules out there. Now, the third point is that they should transact at arm's length price. Now, how do you compute arm's length price? Well, that is what we'll discuss in the next lecture. Please, I will be sharing this, slides, with the institute. So please, go through these particular slides. If you have any questions, I can take up these particular questions in the next lecture. Before we start, I'm going to devote 5 to 10 minutes to see if you have any doubts on this particular lecture. But go through them, go through the ICAI study manual, and go through the law. Section 92 that we've discussed today. And if you have any questions, I'm just happy to answer them. Thank you so much for today. And if you have any questions, I'm happy to answer them. I'm right here to answer the questions. Thank you so much. Thank you so much. Thank you. Thank you so much. See you for the next class. So we can stop recording. Thank you.